It'll be interesting to see whether this bounce back can sustain some legs, JD, but I fear that it won't. We're up early, and it's reasonably solid, and we are seeing a pullback in Treasury bond yields, and I think all of those components are important. But I do think this week will be indicative of where stocks are headed. We're in for a very difficult March, I think, particularly if there are any indications that the Fed is going to become even more hawkish than it is. And there's 6 Fed speakers out in the field this week. So there's every chance that we're going to get some commentary that will lift Fed fund futures and therefore ultimately give us another bounce in Treasury yields. That's going to add further pressure on stocks. But at least for the moment, I think the broadest sentiment that we're seeing is that the economy, despite all assurances to the contrary, is holding up very, very well. The Atlanta Fed GDP forecast has first quarter growth growing at a 2.7% clip. There wasn't anybody that had that on their bingo card even a few weeks ago, let alone a few months ago. So I think as a result, people are just trying to do a straight line calculation by saying, listen, the economy is growing at this pace, then we have to see earnings advance alongside of it, because that's generally always the way it works. Now, the flip side of that is that higher interest rates are going to press down on stock valuations. We don't know who's going to win in that tug of war just yet. But today, it seems investors are a little bit more optimistic about growth prospects. And as a result, they're filtering that in to their prices for stocks as a result of them seeing potentially better earnings growth.